All right.
Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Mark Hunt of Pacific Private Money. Nam-Fon is off today. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. That certificate's not sponsored by the radio station, but by Tan Bala Tanning Salon with 2 locations in San Francisco and 1 in Penn. Today's trivia theme is general trivia. Mark, what is going on in the lending market?
Well, there's a lot going on. Some of what stuff we're going to talk about in today's show is the Fed, the Federal Reserve, just announced that they're not going to raise rates for the next 2 years.
2 years.
Until 2023. But how come mortgage rates keep going up? So we'll talk a little bit about that.
Yeah.
I also have been waiting and looking at my various news sources because I was looking for the list that inevitably comes out whenever government passes a big stimulus bill. So, 6 months ago or 8 months ago when they passed that first $1 trillion bill, remember we talked about how much of that money was going to basically pork barrel purposes. And I knew when they passed the $1.9 trillion fund last week, or bill last week, that, it was only inevitable before the articles started coming out.
Sure.
Where's that money really going? And it's still not an exhaustive list that I have found yet because.
But I thought the Democrats were the people of the public, and it was the evil Republicans who always had all these backdoor pork barrel deals. That's why I've kind of said in the last so many years they're called Democrats and Republicrats.
That's right. Yep. So the Wall Street Journal editorial board estimated that only $800 billion of the 1.9 trillion, less than half, was related to COVID-19 relief. And so a little over $1 trillion was basically expansions of progressive programs, pork, and unrelated policy changes.
Well, I heard it was even less than 800 million if it's like specifically going for COVID.
Well, it depends on how you because COVID relief response includes things like small business relief, agriculture, expanded tax credits, education. But here are some of the lowlights, if you want to call them. A quick spotlight on agencies and entities that are receiving, quote, coronavirus recovery money, and the bill includes $350 billion to bail out 50 states, which basically means states are getting bailout money to use as they please. $130 billion to fund education, which arguably is, I guess, a good thing, but that's an awful lot of money that's usually funded by local governments or states.
Well, also, how is it spent? Just saying it's for education. Who knows what that means? Go ahead.
Here you go, Edward. You'll appreciate it. $86 billion to save nearly 200 pension plans insured by the Pension Benefit Guarantee Corp.
Which they always should have been defined contribution plans, not defined benefit plans.
Guess what? There are no reforms mandated attached to this money. So basically, underwater pensions, which are actually a lot more than $86 billion at this point.
It's got to be.
This just scratches the surface.
Yeah. Okay. So I guess what these managers can do of the pension funds is just go ahead and gamble as much as you want, and if you don't make enough, someone's going to bail you out.
Bail you out, yeah. $50 billion to FEMA, okay.
I got
$40 billion for higher education, $2 billion for Amtrak, which is
hold on, back up. What is higher education? They're going to put people through graduate school? Did they say?
$40 billion to higher education. This amount is 3 times the money that higher ed received with the CARES Act funding from last March. So no, it doesn't go into details. So this is just kind of it's not a long, detailed Wall Street Journal article, but it just, I think they're still, digging through this bill.
Sure.
More to come, in the weeks to come. I'm sure we'll be back here with how many billions are going to foreign governments, how many billions are going to, to prop up the postal service, et cetera.
Yeah.
So
and 500 billion to the feel good fund.
So I'll end this on a really depressing note. So in 2008, the federal debt was 10 trillion. In 2016, 8 years later, it had ballooned to 24 trillion, and it stands at 28 trillion today in 2021. So we're bumping up against the $30 trillion mark, which is 3 times where we were in 2008.
It's all funny money anyway. Hey, tell you what, we're going to go to our first commercial break here because we need a break from that for sure.
I have a headache already.
Yeah, really. All right. First trivia question. What is the Oscar statuette holding in its hands? So have you ever seen you ever watch TV and they have the Oscars? What is the Oscar? What is it? The statuette. What is he holding in his hands? All right. That's our first trivia question. Let's see here. Call 888-912-1190. First caller with the correct answer is going to win that tanning certificate. Want to make a quick mention here for the Mount View Hotel and Spa. When you're ready for a change of scenery, make yourself at home at the Mount View Hotel and Spa. With amazing daily happenings and so many wonderful things to do around the hotel, there's an array of activities just waiting for you. As a small boutique hotel, there are never large crowds, and they offer beautiful indoor and outdoor social distance space so you can relax and continue to live life. Making memories for 100 years. That's the MountViewHotel.com. I don't know if you've ever been there, but beautiful rooms as well as an awesome pool. All right, stay with us. The Best of Investing is going to be right back. Welcome back to the Best of Investing. Edward Brown here along with Mark Hanf of Pacific Private Money. Our first trivia question. What is the Oscar statuette holding in its hands?
I have no idea. I've never seen one up close.
A sword. Very kind of standing there with a sword, yeah. I don't know why, but it's got a sword. Okay, so we were giving the depressing news about the trillion. And then get this, I was reading on Yahoo today that the White House may be proposing $1 trillion in new taxes.
Well, someone's got to pay for $1 trillion in pork barrel politics.
Yeah.
Yeah. Well, so, for those of us who live in the San Francisco Bay Area, it's really distressing to hear that if you make more than $400,000 a year, you're wealthy, and therefore the government's coming after you with higher taxes. So in the form of not only just a higher marginal tax rate if you make more than $400,000, but reduction or elimination of tax deductions you've enjoyed in the past. And last but not least, they're going to increase our capital gains tax rates.
Yes.
So for those of us who sell our expensive California real estate and want to maybe redeploy that money elsewhere, we're going to see our tax bills go higher, which just means that it's really going to force even more people to utilize the 1031 exchange.
Unless they get rid of that.
Expensive assets, which again, is neither here nor there, other than the fact that when capital gains tax rates are low enough to entice people to sell and recognize profits, it's better for tax revenues, and it's also better for the economy because despite the fact that people think trickle down economics was a lie, it's not when it comes to spending, and spending has an average multiplier of anywhere from 10 to 20. So for every dollar that you spend, it multiplies to as high as $20 as it trickles through the economy. And that's a well-known economic precept that is why consumer spending is so important to our economic health and overall GDP growth. It's consumer spending that saves the day when it comes to bailing us out of a recession. So that whole if you want people to spend money, you got to give them incentives. Incentivize people to hoard.
Yeah, I was remembering a little seminar on 1031 exchanges when a couple of years ago they were thinking about getting rid of it, and there was some astronomical number that they said, well, look what will happen. You'll have less in the economy because of real estate agents, title officers. Everything to do with real estate will go down because of the fact that you get rid of that. Yeah. It's unconscionable. And the thing is, it's almost obvious when you think about it. Let's pretend just for a minute that tax rates were 98%. Just to make it really simple, right?
Feels like that to me already.
Yeah. First of all, that you're not going to want to work that hard for only 2 cents on the dollar. And then how are you going to spend? You can't. So ergo, I mean, we can't have tax rates at 3%. We got to get, I understand that. But if they were to lower, like you said, if they lower the capital gains tax rate, people are going to sell the property. They're going to pay taxes. You got more real estate agents, more, I mean, everything more, and the government will actually make more money.
It's just, the progressives in the Democrat Party, they know what plays well to their base, and their base, for the most part, is taught not to believe that if you lower capital gains tax rates, it's going to result in selling more real estate, selling more high valued assets, selling more stock portfolios, and going out and buying stuff that keeps the economy rolling. What they want to hear instead is that you increase the tax rates, and it's going to make those wealthy people who get away with not paying taxes pay more taxes. It
all has to do with votes. And there was this one senator, I've mentioned this before. He was he was a Democrat, and he said, "I don't care if it destroys the economy as long as the rich pay taxes." It's like, oh my, that's ridiculous. The whole idea is
super rich always have a way of not paying taxes. Your Amazons and your Amazon shareholders, the billionaires of the world have a lot of methodology and expertise at their side to help them, minimize their tax bite. The people who live in New York and in California on the East and West Coast who, for whom $1 million annual income is basically an upper middle class lifestyle because of the cost of real estate and fuel and property taxes and all that stuff.
Yeah.
We're the ones that get killed with taxes. Because we don't have the benefit. You and I aren't going,
exactly.
Nothing in taxes. My effective tax rate for 2019, I haven't calculated 2020 yet, but for 2019, it was 60% because of the high property taxes I pay. I happen to move into a new home, and I have, so I'm paying, the property taxes based on the market value, not, some 20-year reduced Prop 13 protected value. So
yeah, exactly. And also,
but I'm just, being at a 60% tax rate effectively between California, the IRS, and local governments. It's very disincentivizing.
It is, absolutely. And one of the other things that they may be proposing, this is just all speculation, is in the blue states, i.e., the East and West Coast, where we got hit with the SALT, right? $10,000 max, they may potentially get rid of that.
Well, I haven't seen anything recently, and for those listening, SALT means state and local tax deductibility. So, Trump did a lot of things for our economy, and his tax reforms or his tax cut bill in 2018 did help a lot of taxpayers, unless you lived in California, New York. Because for those of us in California, for example, that pay high property taxes and
state
have
income taxes,
interest deductions on our mortgages, well, we were capped at $10,000. So
for the interest, but on the taxes, yeah. So on state and local taxes, so yeah, either your income tax or your property taxes. And when we come back, also, but by the way, the IRS deadline, they changed it to May 17th.
Right. So we have an extra 30 days to file and pay our taxes. Now, of course, what I haven't seen yet is it wouldn't surprise me, given how horrifyingly run the state of California, the franchise tax board is, that they would say, well, we're going to go along with the IRS. You don't have to file till May 17, but you better pay your estimated or what you owe by 4/15, or we're going to hammer you.
I would suggest paying them early. Okay, second trivia question. What is the largest city in Africa?
Ooh.
You call 888-912-1190. First caller with the correct answer is going to win that tanning certificate, which is worth over $100. What is the largest city in Africa? Stay with us. The Best of Investing. We'll be right back. Welcome back to the Best of Investing. I'm Edward Brown, along with Mark Hahn. Second trivia question. What is the largest city in Africa?
It's on the tip of my tongue.
Think
Johannesburg.
No, that's actually a pretty good guess. Cairo.
Cairo.
in Egypt.
Oh, Egypt is, that's right.
That's right. Yeah.
I never think of Egypt as being part of Africa.
I know, it's true. You always just think of like Middle East type thing because it's so darn
Cairo's
close
the
there.
biggest city. What's the population?
Oh, I don't know.
All right.
I'm asking the questions here.
All right. Well, let's talk about something we do know about.
Yes.
The Federal Reserve announced this week, and depending on whether you're a saver or a borrower or a little bit of both, it's either good news or bad news. But they basically said that they signaled, whatever that means, that they won't raise interest rates until 2023 at the earliest. So we're talking
a couple years
from now. They're not going to change the federal funds rate. So there's an article in Realtor.com that said the Fed announced plans to keep interest rates low. So why do interest rates keep rising? In other words, what they really mean is why do mortgage rates keep rising? And so we've talked about this a lot over the years, and that the Fed does not determine mortgage rates. The Fed influences short-term rates, and short-term rates affect things like the prime rate and your rate you pay on credit cards and rates on variable loans and consumer loans. But when it comes to mortgages are influenced by long-term rates, more specifically the 10-year T-bill rate. And the 10-year T-bill rate goes up and down based on perceptions of what's happening in the economy. And this new nearly $2 trillion stimulus package, there are fears that it's going to plug so much new cash and capital into the money supply that we're going to see, as a result, higher inflation in the coming years. And whether or not that happens, because that fear has been expressed actually for several years now. There have been those who are bearish in nature have been calling for increased inflation now for a while, and it hasn't happened for a lot of reasons that are way too technical to try to get into in this discussion. But the bottom line is the mortgage rates, while still inexpensive on a historical comparison, at 3.1, it's up quite a bit from what was 2.7, 2.8 at the low. And so nothing's changed in terms of what the Fed has done. The Fed has kept their benchmark rate, at near zero, and the prime rate has been fairly low now, or has been fixed now for over a year. The mortgage rates, though, have about a year ago at this time, I think they were actually similar. It was last summer, last June, July, where they hit their lowest point, basically in our history. And so now they're going up a little bit, and that still makes home buying very affordable. Very few of us in our lifetimes have experienced the ability to buy a home with a 3% mortgage or a 3-ish% mortgage, and that's still a reality today for a lot of people who qualify. So good news on that front. Okay. As far as I'm concerned. Now, when I say good news, it's good news for the cost of money as it relates to buying things and buying real estate. Not so good if you're a saver, wondering when your money markets deposits, your CD deposits, your savings account deposits, and other investments that are tied to interest rates. When are those going to be going up again? And, based on that news from the Fed, probably not anytime soon. So the search for alternative investments or investments in general that are paying higher yields, will continue to be ever more popular. And they're quite popular already today. And so we'll probably spend a good portion of the remainder of the show, talking about the type of investments that we're very bullish on here at the Best of Investing. And of course, for those of you who've heard our show before, you know that we are bullish on real estate debt secured investments because we believe real estate values, especially the residential real estate marketplace in California, is robust, will continue to be robust through this year and likely through 2022 because of supply and demand. We have a high demand for homes, a low-ish supply, not a ton of new construction going on. And regardless of articles that you have read or heard about saying people are fleeing California and all moving to Austin or Washington or Seattle, the numbers actually don't bear that out. The net reduction, in fact, there is no net reduction in California population. Yeah. There continues to be a net increase in California population because of new births and immigration. So the demand for housing is still strong, and the millennials are now entering the market, the home market. Yeah. They're making good money, and they want to buy homes, and there just aren't a lot to go around. So there's a lot of continued upward pressure on home prices in California. In fact, nationwide, this is happening. Nationwide, residential real estate is one of the strongest asset markets that we have today. Now, of course, the stock market's doing great, right? Stock market keeps going up no matter, despite what anybody is predicting about it being overpriced or PE ratios flying out the window.
Well, and in fact, that's what I was going to make this one mention here. Apparently, young investors are putting the stimulus check that they got into stocks and Bitcoin.
Bitcoin, yeah.
Bitcoin, yeah. So now
I'm nervous about that, though, aren't you?
Well, I almost like the idea that they're putting it into stocks because you can always get it out in theory.
Yeah, it's highly liquid. That's good.
Yeah, and then you can, and also it's like that tells me that they're not wasting the money on stupid stuff, and people do need to save. However, investing in Bitcoin, I can say that I was wrong in thinking it was going to, go to zero a few years ago, and I definitely missed the opportunity, so to speak. But you know what? I still am not a believer in it because it's still not backed. Anybody can just create some. Oh, by the way, I invented the Edward coin, and there's only 2 billion of them out there, and that's the limited supply.
Well, I think more and more people are agreeing that Bitcoin is like virtual gold. It doesn't have really, at the end of the day, any intrinsic value. It's basically what people think it's worth. And as long as the stock market's going up and the economy is doing well, Bitcoin is likely to go up. But when things turn sideways, it's probably going to be reactionary, much like gold.
Yeah, because once you can get out and spend it on something.
Yeah.
Okay, here we go. Here's our third trivia question. How old do you have to be to serve in the U.S. Senate? What's the minimum age requirement? All right. 888-912-1190. First caller with the correct answer is going to win that tanning certificate. Also want to make a quick mention here for Mountain Mike's Pizza in San Rafael. Pizza the way it ought to be. Give them a call at Mountain Mike's Pizza in San Rafael. All right, stay with us. The Best of Investing. We'll be right back. Welcome back to The Best of Investing. One more time, I'm Edward Brown, your host, along with Mark Hanf of Pacific Private Money. Third trivia question, how old do you have to be to serve in the U.S. Senate?
Isn't the president 40? So wouldn't the U.S. Senate be like 30 or 35?
I think 35 is the president, and 30 is the answer. 30. Yeah. Okay. Wow. I thought it was 25, but it's 30.
30.
All right, so we want to just finish up on the.
We were just kind of opinionating about.
Yeah, that's a good word.
Bitcoin and the stock market. Again, we're at Pacific Private Money and the Best of Investing. We offer real estate mortgage-based investments, and in fact, you and I, Edward, are have most of our own personal savings as well as our client savings rolled into real estate-based investments, whether real estate itself or real estate mortgages and notes. And speaking for myself, for the most part, I don't. The stock market has changed so much in the last 20 years. And I know this because I have friends who are traders, and some of them just been getting killed because they've been trying to, predict
time the market,
shorting the market here and there, or working on strategies that may have worked well 20 years ago. But, everything has changed, the way stocks are traded and how you can trade, how easy it is to trade, the cost of trades, information as it flows via Reddit and other websites, and the number of people who are participating in just day trading. And it's just with all of that going on, it's just really difficult to know, what's going to happen and predict it. And I will admit, I've been wrong the last 3 years. On the Best of Investing here, we've, especially at the, end of the year or the beginning of the year, we always tend to predict, what asset classes are likely to perform well or underperform. And for the
Yeah.
last 3 years, I predicted the stock market was going to be underwhelming, and I've been
Yeah.
wrong every year. And so, if I were, and if I had to bet, you made me bet $1,000 well, right now, let's talk about right now. I'd probably say, yeah, I would probably bet that the stock market in 2021 would again underperform, or again is in terms of my prediction. I would predict.
Well, and what's the definition of,
because again, I just the PE ratios and other measurements of stock pricing just seem to be thrown out the window, and there seems to be, as one Fed chairman once called it, irrational exuberance going on.
What's your definition of underperforming?
Well, underperforming would be basically no net gain.
Okay.
Now in the end of the year.
So basically a loss.
Yeah. Basically, stocks might go up, but they'll be going down. There'll be a correction at some point. And so, with that, I just feel like I would rather bet on what I personally feel is like a sure thing, even though there's no such thing as a sure thing.
Yeah.
But for me personally, the next best thing to a sure thing is my belief that there really isn't anywhere for residential real estate values to really go other than flat or up.
Everybody needs a place to live.
Yeah.
And especially in California, if you have at least not a migration to other states, in droves, it's just, there's only so much land, that's useful to make houses, and the local governments make it extremely difficult in many cases, or way too expensive. Just the cost of lumber has gone up so much.
So as an asset class that has, the ultimate utility, which is residential real estate, and when I said that it has nowhere to go but flat or up, I don't mean that real estate prices can't decline, because they absolutely can, and they probably will again cycle in the coming years. But again, based on supply and demand, and based on the fact that we're not in a credit bubble, and thanks to Dodd-Frank, we're not likely to be in one again, there just isn't any underlying metrics that would cause a severe downturn in real estate prices. So if you invest in real estate debt, which typically has loan to value and protective equity, and in private money, we normally don't lend more than 70% loan to market value. Now you've got an investment opportunity that can pay you high rates of return, 6, 7, 8, 9%, depending on the strategy of the fund. And yet you've got, it's backed by real estate at conservative loan to value. So it's reliable in a way that you can sleep at night, as opposed to wondering if your $60,000 Bitcoin investment is going to be worth $40,000 in 2 weeks, or your stock portfolio, your Tesla stock, is going to go down, 30% because of some weird revelation or some nuance in the market, or somebody says something stupid on the media and it goes down. It goes down. 30%.
That's a good point. It's a slow moving asset there. Hey, a quick email comes in, or an email comes in, and I want to make a quick one for you. Yeah. At what point will it make sense, if ever, to stop accepting money in any of your funds? So this is somebody who knows Pacific Private Money has funds.
So we have 4 funds in Pacific Private Money. We've actually stopped accepting new money in one of them because we don't have enough assets to purchase, loan assets to purchase. We have what we call the Pacific Southwest Fund that has a strategy of buying seller carryback notes. And we've got a partner in that who's got a brilliant business model that he has a stream of these coming in. But we designed the fund, and it was so popular that we immediately had a backlog of investors. And so when mortgage funds stop taking new dollars, it's usually because they have too many dollars available to deploy. And now our other 3 funds, which are the Pacific Private Money Fund, the Freedom Fund, and the North Star Capital Fund, those 3 funds do not have excess capital. We have, in fact, excess demand for capital. We have excess loan demand right now. And so we could we could probably take $20 million of new investor capital tomorrow and deploy all of it in the next 3 weeks. So we have a very strong demand. So how are we making up for that shortfall? Well, we have about $100 million of investor capital across our three primary funds. And we've got another $100 to $200 million of institutional, I'll call it, capital out there that's purchasing our excess loan portfolio, which we have quite a bit of right now. So we're really in a position where investors who are interested in learning how to earn, these steady, reliable yields, 7, 8, 9% on their money, there's some real options for them to put that money to work right away. So there's no waiting in a long line to get in. It doesn't take months for your funds to deploy, and you could start earning seeing those yields relatively quickly. Within 1 to 3 weeks, your money could be deployed in one of our three funds, our three open funds. So that's really it. That's really one of the biggest reasons why a fund might not take any new capital. And there are some pretty big mortgage funds in California right now that aren't taking new capital in, that they're sitting on $50 million worth of undeployed capital, which
that's a yield drag there, baby.
Yeah. I'd love to be in that. I'd love to have that problem right now at Pacific Private Money. We have our demand is growing very, very strong. We're acting like a startup these days, and we've been marketing quite a bit. So,
okay.
Anyway.
We'll tell you what, we're going to take a quick break. We come back, we'll continue on and also have some closing comments and some fun puns for the day. All right. Stay with us. The Best of Investing. We'll be right back. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Hunt. Boy, it's been a fast hour. It is.
Yeah, so we could sure burn up an hour just talking about stuff.
Yeah. I like to talk about.
I almost used a bad word.
Yeah. No, we like stuff. That's a good one there.
Stuff. Talking about stuff.
It's funny because you mentioned too bad for the audience that they can't get into that Southwest fund because the financials just came out and the yield was 12.3%.
Yeah.
That
one we're going to have to figure something out there. More to come on that one. But we're also very bullish on our North Star Capital Fund. That's the fund that is committed to doing construction loans in California, only in California, and mostly on single-family residential rebuilds, infill projects. Infill means it's like a lot in an existing neighborhood, or maybe a small subdivision, 4 or 6 homes being built, again, in an existing neighborhood where a developer has been able to get plans to split up a lot and build a few homes. And then last but not least, replacing homes damaged by fire. And we've had over 10,000 homes that were lost due to fires in the last several years, and less than half of those homes have been rebuilt, and there's still a very strong demand.
Yeah.
In fact, in almost all the fire areas, as soon as the home is rebuilt, it's sold. There's such a strong demand for those homes.
Mark, how do people get a hold of you? We forgot to mention that last
segment. The age-old question, where do you go? PacificPrivateMoney.com. All one word, of course, PacificPrivateMoney.com. That's the way to at least take a look at who we are. There's a lot of information on there, but the best way to get information is to call our office. Andrea answers the phone and we'll put you through to either myself, Nam Phan, or Edward, and to discuss any one of our funds, or how our funds work. Is there paperwork on it? Yeah, heck yeah. There's all kinds of flyers and executive summaries and such that compare and contrast each of the funds that we have. And then if you're, a realtor or a real estate investor and you're wondering, I haven't checked you guys out yet to see what your cost of money is and what kind of loan programs you have and how I might be able to utilize your capital to help build wealth in real estate. We'd love to hear from you. And we've got a number of senior underwriters here at Pacific Private Money that'd be happy to talk to you about our various loan programs, including ground-up construction loans, fix and flip loans, fix and hold loans, and our ever-popular consumer bridge loan to help you buy your next property without having to move first. We can make you one loan secured by the target property you're looking to buy, as well as the equity in your existing home, and you can move once. You don't have to sell first, and it's just a great tool for you if you're a realtor or an end buyer, and you're looking for a way to compete in this crazy market where you can make a cash-like offer with one of our funding commitments and make a home offer without a financing contingency and a quick close.
Yeah. You know, it's funny.
Information, pacificprivatemoney.com. There's a lot of information on there, but also call us. We're in the 415 at 415-883-2150, 415-883-2150.
And I forgot to mention, yesterday a call came in, and I asked the lady, I said, how'd you hear about Pacific Private Money? And she said, oh, just a random Google search of hard money lenders in California, and you guys like popped up as number one. So the Pacific Private Money company is growing quite a bit. You want to give them a call at 415-883, excuse me, that's my cell phone, 415-883-2150.
They can call your cell phone.
They can call my cell phone.
Don't give it out on the air.
All right, you guys, are you ready? We're going to go. Here's our puns for the day.
Yes.
I once worked at a cheap pizza shop to get by. I needed the dough. And yeah, that's bad. And this one's not a pun, but this is a good one. Learn to judge your moves by their long-term effects on people. That's a good thought. I like that. Yeah. And then lastly, what did the pig say to her lover? Don't go baking my heart. That's bad.
Elton Pig.
That's right. I was going to say, do you remember that song? Yes, you do. All right. Tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.